70% of founders are disappointed in the value of their business and lack the tools to figure how to fix it. Matt Harrison, president and co-founder of Horizon Advisors, it's good to have you on the Personal CFO podcast.
It's great to be here. Thank you for having me.
Do you mind giving a brief description of yourself and what you do at Horizon Advisor?
Sure. So my background, briefly 10 years in banking with RBC, and then about half a decade in mergers and acquisitions, and then started Horizon Advisors because I saw too many founders not having great exits and going through some tough times and being forced into sale. And so that's part of the reason why we started our business.
And who is involved? You, your wife, and...
So the business today is my wife and myself, and then we also have some other advisors as we're building this beyond ourselves, primarily exited founders of an 8 or 9 figure business. We really want folks who have been through that journey because it really is a journey, and going through that exit is not just a business thing. It is also very much a financial and emotional journey for a lot of founders. And we want to bring some aspects of folks who have gone through that to owners. And so my wife, Kristen, she's a 4 times founder prior to Horizon. She's been a private equity-backed CEO. She's been in the C-suite and various other businesses. Between her and my M&A experience, we really wanted to bring that to owners and help them increase value in their companies and enjoy their jobs as they're going through it, have a business that's actually worth owning, and then have optionality to go through a sale process when the time is right and give them control as they go through that.
Well, I'm excited to have you on the podcast and dive deeper in the subject here. But before, I just want to give the listener, why is it important to talk about exit planning, business growth, and all the challenges among this? Why is it important to talk about this on a podcast? Why should people listen to our conversation today?
I feel like most people think that exit planning is this like, I'm leaving my business right now. And it's kind of when you're starting with the M&A firm. I think the term just doesn't resonate with a lot of folks. So I don't necessarily love the term exit planning. What we really focus on, and I think this is a contingent of the overall like exit planning market, but building a business that's valuable, transferable, it doesn't fall apart without you. It's executing solid business strategy across your company. It's having things documented. It's removing the critical risks in your business. It's understanding what buyers want to pay for. And it's understanding from an owner perspective, what is your North Star outside of the business? And how do we create optionality towards that and bring in some of those components, whether it's philanthropy, whether it's giving your time back into today so that you know when you actually do exit, that you have something afterwards, a purpose to go towards that really resonates with you. Because a lot of owners regret their exit, and it's not just financial. It's often the people. It's the being needed in the job. It's being a part of what you built and letting that go.
Yeah, huge part of their identity for most of their career, right? It's their third
Exactly.
job, right?
Yep. Yep.
Who is this conversation for ideally today?
Well, I think it's for just about any founder. I think even owners in early stages of building their business, if you're thinking towards how is somebody going to look at my lens from an outside perspective? If I were to invest in my own company, what are the things I would want to see? How would I reframe how I'm building today to get towards that target? It is really fundamentally what we're trying to do. And I think, our primary target market is owners who are one of two things. They're either scaling at, let's say, like 30, 40% year over year. They've got a team and they're reinvesting. And somewhat profitable. That's not always true, but for the most part, they're profitable and growing at that rate and just reinvesting. The majority of our business falls in with owners that are north of $1 million in EBITDA. So that's earnings before interest, taxes, depreciation, amortization. If you want a simple proxy to it, just kind of think your net profit at the end of the day. Upwards of like 10 million plus in EBITDA. Why the $1 million? 2 reasons. One is, this is a good piece of information for a lot of owners as you're trying to build. Once you hit $1 million in EBITDA, your buyer pool is substantially larger. I think it's something like 70% larger because that's where a lot of private equity firms want to start investing. That's where it starts to make sense from a lot of strategic businesses of where it's enough for them to have a significant investment that actually helps their business grow further. And it's also where you have most likely a team around you, some sort of management team. You have the cash flow to make decisions to continue scaling your business and thinking through it from that value creation lens.
That's interesting. When you think about, so in terms of 30%, let's say margins, so that would be around what, 3 million, depending on the type of business in terms of revenue. Is that what we're looking for?
Oh, sorry. On the 30%, that was more around their scaling at that rate. So high growth businesses, maybe they're not at $1 million in EBITDA, but they're reinvesting in their bottom line, and so they're probably somewhat profitable, but not too much so. And so we work with some clients as they scale, the wheels are coming off. We bring some of that operational perspective to them and think through like, okay, how do we continue building this business so it scales well beyond where it is today? Because, you hit a couple of points in your growth, whether it's like the 5 million revenue, 10 million, 25 million revenue, where things just kind of start falling apart. And you have to think through, okay, what's that layer of management? What's that new product offering? What's that division of the business that we have to put in, and what are the value creation levers we need to start pulling to continue that growth? What's the timeline for it? How much is this going to impact our business, either from a multiple perspective? We could talk about valuations, but most businesses are valued on EBITDA multiple, or from an actual earnings perspective. What are we going to drive to the bottom line at the end of the day?
Okay, let's dive into, I know on your website you mentioned there's 4 kind of key challenges that you touch on: the founder bottleneck, the stalled growth, the growing pains, and then people who have no exit strategy. And those are 4 big topics in themselves. Let's start with the founder dependency problem. So what does that actually look like, on a day-to-day basis, or like when you first meet with clients who this is by far their biggest challenge?
Yeah, it can truly vary as to what founder dependency looks like. The simplest metric I would say to look at that is, how many hours a week are you putting into the business? If you're beyond 40 hours a week, there's probably some level of a dependency on you as a founder. What are you spending your time on? And we'll do things with owners and go through like a time audit with them as to what they're actually spending those hours on, and is it something that's a value driving the business forward. I have had clients where they have a near 9-figure business, and they're the ones clearing the driveway from the snow. And it's the conversation of like, okay, is that where your time should be spent if you want to continue to grow your business? What else could we be doing with that? Where's the leverage for your business? For anyone, and especially owners, time is your greatest resource, and making sure you have a substantial focus as to where that goes is absolutely critical if you want to continue to scale your company. And so dependency for us often looks like time, but there's also other components of it. It can be that process. It can be access to financials. I have heard of scenarios before where a founder was unable to come into the office, and who has access to our financials, who can pay our customers, who knows what email address that goes to. And so when you retain all that information to yourself and you don't have some sort of documentation as to if something were to happen, there can be major downstream effects. And so a good chunk of the like exit planning portion, if you will, on a more formal basis, is protecting the value that you've built in your company already before you start focusing on the growth components. And so that just means like business continuity. Sometimes it can mean like a contingency plan with your executive team. Not fun things to put together, but you put down 2 or 3 hours. And if somebody has to leave on your team, you've already got your plan. It turns a crisis into a decision point where the plan's already in place for it.
You've alluded to a few points here, but from your experience, what is the biggest aspect of their business that they need to take off their plate? Or in other words, what would be the most impactful next hire in place in order to really start removing themselves like substantially from that bottleneck, in your experience?
It is, in my experience, it is mostly sales. Most founders feel that they are the best salesperson in their organization. It's one of the hardest things to give up. You sell your product, you know it inside out. You can show up to just about any meeting and be ready to go and absolutely hit a home run in that, because you understand what your business is, you understand what the client's needs are. You have to systematize that. You have to bring somebody else who could do it. I have sat in the room with a founder going through a sale process, and they say to the buyer, "I'm the best salesperson in my company." That's not a great thing, because then the buyer's going to say, "Well, okay, we're going to need you to stick around longer because you probably have most of those relationships. We have to do a handover for those relationships. We're probably going to have to pull out some of that sales process knowledge that you have and start giving it to other people." Is it repeatable, or is it really just you as the owner doing this? Because a founder-led sales process often has a higher success because people feel they're getting the founder in the room. They're getting that attention from a sales perspective. Can Susan in sales do it versus Tim, the owner? It's a big question that somebody's going to ask at that point, and key founder dependency pieces. And so if you can have a repeatable sales process, you can scale your business. And so I would say that's the primary one for most owners to let go of.
I didn't expect that. I was expecting more. You would think like operations or maybe lower hanging fruits and that kind of stuff, but it totally makes sense. Of course.
Yep. Yeah,
totally
there are other components too. Yeah, like from an operations perspective, there are those things.
Sure.
People have a process they want to hold on to. I think for different people, it's different. But from a scalability for your company, I think sales is often the most common one.
That makes sense. And psychologically, what have you seen in founders? What were the challenges that they had to overcome in order to let that go, in order to share their secret sauce with a proper sales teams and with proper procedures and practices and whatnot?
I think sometimes owners just don't want to let it go, and that's a decision that they can make, and it is hard to let go of these things. We talked about the emotional journey before, and especially as you're going through an exit, like it is a very emotional thing. You have built this from the ground up. Nobody's going to do it as well as you have, and I think there has to be an acceptance of that. That if you can get somebody to 70, 80% in like 6 months to a year, that's actually pretty amazing considering you're the founder and you've lived and breathed this from day one. But there does have to be an acceptance that it's not going to be the same quality as you need. But it's investing in those people and starting to document that process. What is the language we use? What is the framing we use? And like having to build out a go-to-market strategy from a sales perspective is not something a lot of people have like really sat down and thought through end to end what that looks like and how can I make this repeatable. And so as we go through with clients, and it can be sales or operations or anything else, it's just asking that question of like, okay, how do I make this repeatable? When I go into this meeting, what is my preparation? How can I start documenting that today? When we're going through like the solutions we're presenting to a client or the problems that they're having, their pain points, how are we uncovering that? What are the questions we're asking to pull that out from clients? And it really just comes down to, okay, Matt, if I were to hand this off to somebody else tomorrow, like what is the playbook for them to go through? And they're not going to get it perfect on the first time to your standards, but they have to have that experience and go through some of it. So letting go and then having the playbook to hand off. And then obviously there's a coaching component to that. You do need to be a part of that process to grow, especially when you're a business that's, let's say, around that $1 million in EBITDA. Nothing's fully polished. It's not like you have 20 people on your sales team. You've got to start building that person up. And there is a challenge to that. Making sure you hire and retain the right people is obviously a large component of that.
Yeah.
But yeah, the documentation piece, because if that person leaves your team down the line, you want to have the playbook for the next person. That's just part of the business world. And my perspective is you want people to continue to succeed in your company where possible. And sometimes it's not going to be within your business and you want them to go do other things as well. And that's just going to happen. So I want to make sure that the next person coming in can really take that over and continue to scale it from where it was.
What would you say to a founder that, let's say, is I don't know, is scared or worried or the right words of giving away their secret sauce in the sense that I put all this time in this person to transfer all my knowledge to train them, and then I mean it's always a risk, right? Them leaving or them maybe even starting their company depending on the size. How have you guided founders through this, through overcoming that fear?
The fear of the knowledge being taken away from your business. And
yes, because a lot of people, why they're probably holding on to it is probably they think they're the best at what they do. And then as you start, I guess, training other people and stuff, like, do you see people being, or founders being reluctant in that, or they understand, or do they actually really understand why the need and the priority and why it's really important for them to reach the net level? Like, is it an obvious next step to them to kind of be able to train a Salesforce team, or do you see people who are, no, they want to hold on, they want to keep, they have a hard time implementing this?
yeah, I think for all of us, it's hard to let go of the things that we have built, right? Like as you've built a system or a process, it's working well. Like it's hard to let it go. I think there's probably an innate fear of like, it's going to get messed up and, they won't do it as well as me. And I think we probably all experienced that in various jobs in our lives. And if, somebody's starting to take over a part of your role, whether you're a founder or not, like it's a difficult thing to go through. In the conversations with founders and the framing, if somebody were going to buy your business, let's just say it's a private equity firm, they're going to replace you and they're going to try and scale your business. That's why they're buying you. Most private equity firms have like a 4 to 7 year time horizon that they want to buy a business, scale it and sell it. They're probably looking for something like a 3 to 4 times return over that time period. They are going to scale your business with you or without you. And so do you want to do that yourself or do you want somebody else to do it to really grow your business from where it is today to where it could be? If somebody came to you and said, hey, Guy, I can scale your business 4x and you can be a part of it and we're going to do all these wonderful things and you want to be a part of that journey, because obviously there's a lot of work behind it, that can be a great incentive. Not every owner wants to have that journey though. Sometimes maybe it's just not wanting to have that level of growth because that is a challenge to go through. But what is it? What is their North Star? And then framing it around getting to that objective. And often there does have to be that acceptance and letting go of that component. So from a growth perspective, from a maximizing value, it's often that conversation of private equity is going to do it anyways. And if it's, sometimes clients are closer to a sale process and that's just not going to happen. So let's start documenting it. Let's show to a buyer that we have done this, that it can be repeated. And then for somebody who's building more of like a generational business or they're wanting to step back, it's the question, okay, if you're going to step back from this company, can you truly do that if you're running, all of the sales, or if you're doing all of the operations pieces, or if you're basically being your CFO for everything, can you truly step back if you want to get to that chair of the board kind of role? If you're holding on to this. And when they start thinking about it from that perspective of an outside investor looking in for themselves on their own company, there often is a mental shift towards, okay, if I do want to get there, I have to let some of this go. I have to document some of this. I have to get somebody else in here to start doing this work. And it's not easy. And it's often, a multi-year process to get that rolling.
When you think about 1 million in EBITDA, traditionally, that will depend from sector to sector, but what is the company size that we tend to be looking at that point in time in terms of employee counts?
In terms of employee counts, it can vary. We've had
Yeah.
clients that had 5 full-time employees and a contractor that were doing nearly $3 million in EBITDA. I have heard recently of some, one-person businesses that are doing north of 5 million in EBITDA. I have also worked with clients that have 80 plus employees and are doing 1.5 million in EBITDA. It depends on the business. And, for those clients, like some of them are doing really, really well in terms of like the health of the business and how things are operating. Sometimes it was a big contract came in and they're scaling and like things are falling apart. For the client with 80 plus employees, that one has tons of upside potential in terms of what they can do with that business. And frankly, I think they could probably 5x their earnings over the next 1 to 2 years based off of some improvements that they can do in the business. So it varies situation to situation. Generally speaking, you probably want to have a business north of 15% EBITDA margins would be healthy as like a broad model to use. And then in terms of number of employees at that point, I think it really can vary industry to industry. You could have a commercial cleaning business and have 100 cleaners, and you're getting towards that perspective. So it's hard to give an exact number, but for us, for the clients we work with, I would say for the most part, there are 15 plus employees.
Yeah. Okay. The reason I'm asking this is because let's say you've passed the founder bottleneck. So let's say at that point you have about 15 employees. If you train them well, you can step away for 2 weeks plus that, but they go on vacation, depending on like what let's say you were able to reach that point and you have the right people in the right seats. And you're at that point when you pass that kind of founder bottleneck, you do have a team supporting you and you trust them, with pretty high stake decisions at that point in time, given that you've given them you've empowered them, as much as possible. What are the next, what tends to be the next challenges that would stall their growth at that point in time when you're past that founder side that you usually tend to see?
Yeah. So if we get through the founder dependency component, you obviously have a much healthier business. And we usually frame it as like if you were to step away for 4 weeks, we don't like the bus test. If you're to take a vacation for 4 weeks onto
Yeah.
a tropical island with no cell phone service and no
Yeah.
Starlink, what falls apart first? And that's how we kind of frame what do we need to think through and start working with the business. But let's say you solved all of that. What's next? So you're probably having, less than 40 hours a week of required time in the office. It's where do we want to go with this business? How do we want to grow it? For a lot of owners, you hear the do you work on your business or in your business kind of framing. You have to be able to set time aside to work on your business. When we work with clients, it's typically through 2 sessions monthly for 2 hours each. And it's really bringing full strategy into that owner's life and setting aside designated time for them to grow the business. So obviously, once we've set aside the dependency portion and solve some of those components. And so it really is, what are the levers we can pull for us to continue scaling to get to the point we want to? Or it can be, hey, I want to sell this business in 6 months to a year. How do we start getting ready for that process? How do we start understanding what our EBITDA normalizations are for a business? And for an EBITDA normalization, just high level, it's removing one-time non-recurring expenses from your business. M&A advisors will go through that exercise. We do it with our clients as they're getting a little bit closer to a sale, because you want to track those components. You want to make sure that you're understanding not everybody runs a lifestyle business, but if you're putting personal expenses through your company, those shouldn't be a part of it. Do we have all of our client contracts documented? Are our employee contracts up to date and legal in the provinces or states that they are in? And so it starts becoming more of that readiness conversation. But regardless, it's once you remove the owner from all those day-to-day dependencies, they become that builder again. They become more of that visionary. What do I want to do with my business and how are we going to get there? And we bring some of that strategic thinking to them, as well as the optionality in their company, understanding how a buyer is going to look at it, and really trying to align that to what their North Star actually is.
Defining that. We'll get back to this in a second. I just have one more question
Sure.
around the bottleneck that I thought
Yeah.
was interesting when you mentioned the 4 weeks test. What usually tend to be the first thing to break apart that you've seen?
The first thing, I
Yeah,
don't know
or
if it's the
one of the
same
one
every
of the
single
few.
time.
yeah, when they try to test it, like what are the things, like aside from what we've already touched on, the sales and whatever. Let's say they're trying to empower their team. What is usually tend to be the things that has not maybe been implemented properly, or tends to break.
I don't know if it's the same thing every time. I think every owner has a response that's like right there. It does not take them very long to think about what breaks first. I have heard it be like the CFO financial side of things and like what's going to happen there. I have seen it on the operation side, like, customer complaints are not going to get resolved. People are not going to be sending out the emails they're supposed to do. Like, I have to stay on top of them to get that done. I have seen it on the sales side of like things aren't going to close because I'm not there. I have seen it where it's like nobody can do anything without my approval in the company. And it's like, well, okay, that's a much larger problem. Like, we need to talk about that. Sometimes it can be signatures, approvals for things. Like, if you're a director of the company, who else has signing authority? That can be a very interesting one sometimes when that comes up for a few things. So I really do think it varies company to company, and it is all the things that most people think about, but it just varies from business to business as to what is their critical dependency either on them, or what is that area of the business that needs to get worked on, that maybe is insufficient, that doesn't have the staffing it needs, that doesn't have the leadership it needs, or doesn't have the standard operating procedures that are there. So sorry, I can't
Yeah.
give you a perfect response on
Nah.
that one, but
Yeah.
I think every owner has it on the tip of their tongue, and if you're to ask them, it does not take them very long to think through it.
Yeah. You've mentioned North Star a few times, defining their North Star and how critical that is in terms of, their vision. Can you talk about your process through your coaching about defining the North Star, helping them even find what it is? I would assume that they would probably come in and with some sort of a vision in the first place, but sometimes they might be looking for, I'm sure, your guidance into what that looked like for them. Can you walk me through the process?
Yeah. So as part of our advisory work, it really is understanding like, what do you want to get out of this company at the end of the day? For some people, it's legacy. We have some clients where they want to hand it down to their children over time. And how do we align to that journey at the end of the day? So from a generational perspective, I love working with those clients because they are not thinking in a short-term time horizon. Everything is a long-term investment. How do we maximize this? And what is the outcome you want for them? Sometimes it is like cash in the business, and it is scaling and growing this company to something much bigger. And how do we start bringing in those children to the company so that we actually understand that's what they want? Because the last thing you want to have in that scenario is you build something for 10 years, you think your son or daughter is going to take over the company, and they say, you know what, I really don't want to do this. And you've been building for 10 years, and then all of a sudden it's not the answer you wanted. So how can we start bringing those conversations in, to really make sure like this is what they want to do? They're going to be part of the business, they're growing into it, and those types of things. For other clients, it's understanding, is it a date or a dollar figure we're going towards? We work with some owners where it's, I want to be out in July of 2027. Great. Like, is there a reason behind that? Let's just understand, what's driving that, and then building towards that and maximizing the value in the time frame that we have while getting them ready for that sale process, talking about diligence, talking about what buyers are going to have, building relationships with some M&A firms ahead of time so that they're understanding that process, they know who they're going to work with, and those types of things. And then sometimes it's just it's a dollar figure, and I just want to build towards it just because, so I can say the number, and that's totally okay too. And then other times it's just, hey, I enjoy this. I want it to be an asset, but I understand like I want to have the option to exit when I want to. And I want to continue scaling this company, and we'll keep it as a long term vision. Typically, we ask the question every quarter of clients, love it or list it, if you will. Do you want to stay with your company, or are you starting to think of a sale process? What's driving that? The North Star will often work with financial advisors such as yourself. And for clients that come to us, we help them understand what their business might be worth. We give them an understanding of the value of their company. And the one thing I want to say is no business owner knows what their company is worth until the money's hit their bank account. Valuations can change, going into closing. The hours before closing, you can have adjustments to valuation. That's not a fun experience to go through, but it can happen. Country club multiples, everybody talks through them. It's probably not what your business is going to sell for at the end of the day. And there's a joke in the M&A space of multiple of what? Like, buyers can say I bought something for 4 times, sellers can say I sold it for 10 times, and they can both be true, right? There's earnout
And
components, there's different deal structures. And so what we want to do is just help clients understand like baseline of what their company could be worth. And then working with their financial advisor on what is that life after business going to look like, and
Mhm.
building a financial plan towards it. Because if you understand what you want to have outside of your business, and you understand how much money you may need to do that, if you understand what your business is worth, then you can align what those two worlds, when they can actually kind of come together. When a sale of your company can lead to that dream outcome for you personally, And that gives you real optionality. Like if you know, hey, my business is worth way more than what I actually need for whatever my life after business is going to be, I can do whatever I want with it. And that's very empowering for a lot of owners. And I had a client recently, we helped them go through that process, and their company was worth way more than they thought it was. And it was like,
Yeah.
let's go through a sale process. Like I've got my dream outcome right now. Engage with an M&A firm. Let's start going through that process. And it's really wonderful to see them like starting to come to that realization of what they want to get out of this. So I hope that answers your question. Kind of a long-winded way
Yeah.
of going through it, but it varies client to client. And we really want to personally understand what they want to get out of this. When you've gone through the exit, what do you want to be true?
No, no, this is great. When you talk about that specific exit value, exit number, now you just mentioned an example where actually it was the opposite, where they were so surprised to see that their valuation of the business was higher than they thought, which is amazing.
Yeah.
On the flip side of that, do you tend to see the opposite, that usually owners will tend to overshoot the value of their own business versus when they go to market? And what do you think is the biggest driver of that gap from your experience?
So yes, I think most owners think their
Yeah.
company is worth more than it actually is. I've had conversations with business owners in the past couple of months where they thought their company was like $50 million, and it's like, it's probably worth 2025 at best. And so it's a tough conversation to have, but walking through with owners how companies are valued, sometimes we'll pull up some comparable transactions and walk them through that. It's good to have that understanding well ahead of a sale transaction versus having super high expectations, being disappointed by it, and then are you forced to go through with a process or with like signing the documents that may not be your optimal outcome. So yes, I think most owners do think the businesses are worth more than they are today, especially when you're talking in that like lower middle market. So that 1 to 5 million kind of EBITDA range. It's a tough conversation to have with owners. But I think that understanding what your company at a high level might be worth is really important. And then understanding how buyers value your business, understanding what do they really want from your company if you're looking to build a sale and maximize the valuation of it, so that you can build towards that. And you can say, hey, I've got a gap here. I don't have enough if I were to sell my company to do whatever that dream outcome is later on. How can I close it? What's the work we can do? Because if you have your own business, it usually is the highest leverage opportunity you have to create value for yourself and for your family. And investing a couple of years in doing that, especially if you're thinking of building towards a sale, you can add 7 or 8 figures of value to your company. I had a conversation with an owner 2 weeks ago, one of our clients, and there were some things that were uncovered in their business. And it's like, hey, that's worth $34 million of value when you go to a sale process. Like, here's what we need to do to document it and understand it and work towards that. But these are the types of conversations you want to have well ahead of time.
Yeah. And when can you elaborate a bit more into like these gaps? Like what were they caused by? Like whether that, for example, that 34 million of value creation, was that coming from one specific lever that you guys could pull? And on the flip side, that one where they thought that it would be 50 million, and it was like at best 20. I mean, there's probably a massive deal killer in there that maybe wasn't identified, right? What can you give us, like without disclosing too much detail about the specific
Yeah,
deal? Like,
absolutely.
yeah.
So on the $34 million in value, it's around a process within their company that had not been optimized. So when going back to the EBITDA normalization conversation, if you can make a true justification of this problem was solved. So let's just say you weren't I'm trying to think of an adjacent thing that I could make to compare this. Let's just say, I don't know, your portfolios, like your software for calculating portfolio returns was off by 5%. And actually the actual returns were 5% higher, but you weren't getting paid on it for your business. It's not a great example, but I think you can understand where I'm going with it. If you understand, hey, we were missing on 5% of our total assets under management for our business on what we should be earning, and you hadn't been paid on that, well, wait a second, you should have been paid on that in the past. And so if you're going through a sale right now, you can make a justification, hey, this was a problem in our business. We documented it. Here's exactly what went wrong. Here's what we did to fix it. It's never going to happen again. On an ongoing basis, this company is actually generating $5 million more a year, whatever the number is. And then you multiply that by the multiple for the company. And so you can create real value if you're understanding what has gone wrong in your company. Because if a buyer finds something like that, they're not going to tell you. Why would they
Yeah.
offer you, several $1 million in earnings on a go forward basis? They're going to see that and say, hey, this is great for us. We'll take that for ourselves. Thank you very much, and continue building value. So for that one client, it was understanding a process within their business where they had not been getting as much earnings as they should have been. And so identifying that, solving it, making sure it's never going to happen again, documenting it, having that case. So should they want to sell in the next couple of years, here you go. This is exactly what happened, what we did to solve it, and justifying that value add to the company. And that's a concept that most owners, don't think through because they haven't had to. It's not part of day-to-day operations for your company. On the other example of a company that was worth about half of what they thought it was kind of more of a country club multiple sort of thing. They had been talking about a business and they were told that it sold for, I think it was like 14 times EBITDA. And they were thinking that's what their company was worth. And the company that they were talking about was, I think it was 8 times the size of their business. It had a very large strategic opportunity for the buyer that came in. They were entering into a new market. They were coming into North America. And so there's a whole lot of like strategic things behind it. And then I mentioned a little bit earlier, buyer says they bought it for 4 times or whatever, and seller says they sold it for 10 times. There's a lot of structure as a part of those deals. You don't know if that was a cash deal. Sometimes headlines get all of our attention, but we don't understand what all the components were behind it. And for that company, in the industry that they trade in, there's a decent number of transactions, and most of them don't go for north of 10x. Most of them are around 4 to 5 times. And so just having that conversation with an owner, it's tough, but the reality is most companies don't sell for north of 10 times EBITDA.
Yeah. So just misalign the comparables there in terms of comparing maybe
Absolutely.
what
And
the
everybody
potential.
wants, yeah, everybody wants their business to be worth the absolute maximum. It's what you created. You've got a lot of pride behind it, and you should. It's something you've spent a lot of time and you've put the blood, sweat, and tears into it. But it's just understanding what it theoretically could be worth, and then ideally having an optimal outcome above and beyond that. But you don't want to be the business owner going into a sale process and coming out the other end where it's not what you wanted. If you stop a sale process, when you go back to sell again in the future, every buyer is going to say, "Hey, you were up for sale 2-3 years ago. What changed? Like, what's really different now? Why should I come and buy you now? You stopped the process last time, but why are you going to stop it this time?" And so when you go to actually sell your company, you want to make sure you have conviction to go through that process, because it can be very hard to go through it a second or third time.
Yeah. Before the owners reach out to you or get in touch with you and your team, who have been surrounded them before in terms of like strategic advisors or in terms of their advisory team that gave them advice and whatnot? Like, who was part of their team before they usually tend to engage with a firm like yours?
Yeah, no, it's a good question.
Yeah. Like, who they
All
relied
of our
on?
clients, yeah. I mean, all of our clients are going to have like an accountant who's doing their
Yeah.
financials and that sort of thing. They're going to have a
Yeah.
lawyer, but oftentimes it comes through a financial advisor, such as yourself. And it's that conversation of you're doing the plan for things down the line. You're talking about life insurance. You're talking about protecting the value of your business for your family. And that's often what kind of drives the conversation is, so, well, what do we want to do with this? What is your business worth? How do we grow towards it? And we'll often get referrals through financial advisors at that point in time. And so, yeah, it certainly can vary. But I think for accountants, for lawyers, I think a little bit less so as to what comes towards us from them. I think there are some really amazing accountants and lawyers out there, but oftentimes there's also a bit of a siloing within some of those skills. And something that we try and do is getting the business owner surrounded by those folks, and especially if they're building towards a specific date or there's a vision towards what they want to go towards. When was the last time we talked to a lawyer about, hey, I think I might want to sell my company. What are the implications from your perspective? Talking to your accountant, I think I want to sell my company. Like, what are the things we should start doing today to start preparing for a sale process down the line? You want to make sure you have clean financials. You want to make sure you're not having, some of those personal components in your business as a part of it. Talking to your financial advisor, what's the plan? Do we have the estate planning done? From a tax planning perspective, that's a huge one. Like, if you're a business owner listening to this podcast right now and you are even contemplating the sale of your company, even if you're thinking it's like 5-10 years out, get your tax planning done. I've seen it happen many, many times where an owner puts it off. And then all of a sudden they're like, I really need to sell the company now. I really want to sell the company now. I just can't do this anymore. And they haven't done it. And you can truly be leaving 7 figures on the table very easily. If in the Canadian marketplace, your lifetime capital gains exemption, is, I forget the exact number now, it's like 1.25 million or something like that. If you'd have, between you and your spouse, if you can do a family trust, it takes 2 years to get most of that planning done to get it crystallized. You're talking $5 million if you've got 2 kids and parents and you do a family trust. That is a very substantial tax benefit to yourself, especially when you're talking businesses kind of around that $1 million EBITDA mark. So I know I'm a little bit off of what your question was there,
Yeah.
but yeah, lots of different advisors as a part of it.
Yeah. Yeah.
But we just want to make sure that there's more communication happening between them, especially as you're building towards that sale process, because everybody has a component to that. Everybody has an understanding for it, and just connecting those dots as much as possible to make sure there's not any gaps that somebody's going to find in a diligence process.
Yeah. And in terms of, you've already touched on it a little bit earlier in the conversation, but when you talk about like guidance and working with your clients, tends to be the first of all the time frame? You've mentioned a cadence, but what's usually tends to be the time frame? And then can you talk also how does that interact towards the the inclusion of like the M&A partner, and then you know that whole kind of like a timeline in terms of leading up to that exit? And I'm sure that will depend on all sorts of variables like how they exit, what route they're taking. Are they fully scaling back? Are they staying partially? Are they maybe transferring to the next generation? But generally speaking, like what tends to be your involvement? What's the time frame? And then how are you interacting with the other parties when it's time to actually execute on the deal?
Yeah, absolutely. Um, to your point, it can vary substantially. I have had a phone call from some clients who we'd spoken to in the past. They didn't engage with our services. And it was, hey, we got our dream buyer who just called us and said, we want to buy you. Can you help us? And so I have worked with clients on that basis of, okay, let's just kind of go through this process a little bit. They were a bit on the smaller end, wasn't quite like an M&A process. And it was a now thing. Like literally, over the next week, it was kind of getting everything ready, getting their advisors, their ducks in a row, and coming with a presentation to the buyer, and they're having those conversations now, which is great. So that's like the extreme end on one side. What we typically want to do with clients is engage with them 2 to 3 years prior to that sale process. Why 2 to 3 years? Because you can actually make some substantial differences in your business. You can get some of those processes done. You can build up that team. You can really start adding value to your company, especially again, thinking through that lens of if someone's going to buy my business, what do they want to see? It's very much a mental shift than how am I operating my business today and what problem am I just trying to solve? What's going to create the enterprise value? So that can very much take 2 to 3 years. And then again, going back to that tax planning thing, that's 2 years right there. Most people don't have it done, unfortunately. And so if you want to maximize value, that's often one of the quickest levers on the personal factors of what can do that for you. So 2 to 3 years to build the business, to get yourself ready, to think through all of the processes going to come ahead. And then what most owners don't realize is the length of time it actually takes to exit your business. And when I say exit your business in this regard, it's like completely out of it. You're no longer at the office. You don't have to show up. There's no responsibility. You are off and on to the next thing, whatever that might be. So for an M&A sale process, once you've engaged with an advisor, typically most folks will say that's an 8 to 10 month process end to end. Usually it's like 2 months of pre-market work, which is building your confidential information memorandum or SIM. Think of it as like a PowerPoint presentation, 30 to 70 pages on why somebody should buy your company. It's getting it's called like a blind teaser document ready. So before somebody has signed an NDA, what do they get to understand about your business to then sign the NDA, to then get the confidential information memorandum? So, sorry, 8 weeks pre-market, 8 weeks in market, actually talking to buyers for the M&A firm. And then you get your LOI signed and you're into a diligence process. That's typically 60 to 90 days. When you put all that together, it's 8 months, and then it can kind of go up to 10. And in some conversations I've had more recently with M&A advisors, that's driving towards 12 to 16 months. Now, I've been told that financing is a little bit tougher. Diligence is getting more and more stringent. And so it can take you, let's just say a year, just for a simple timeline here, to go through that sale process. And then the last component is how long are you going to be required to stay in your company post sale? And you can set a firm date of I'm only going to work a year, but if you have a business that's highly dependent on you, there's going to be a discount for that at the end of the day. I have seen buyers say we'd really like you to stay for 5 years because we think you're so amazing. And oftentimes it's with strategics. So like think a large company, think like an RBC buying up something on the fintech side. We want to stay for 5 years because this is somewhat of an acqui-hire. We want you to come and lead the division, and there's a lot of value there. And then it can vary, but my point here is 1 year is kind of the minimum in most regards. I've seen a 30-day process. That was definitely an outlier, but you're going to probably have to spend at least 1 year, possibly 2, maybe 3. Like those are not unrealistic timelines depending on the size of your business and how much you've removed yourself from it. So now we're talking 2 to 3 years pre-sale work, 1 year of actually going through the sale. So we're at, let's just use the shorter end. So 2 years pre-sale, 1 year in the sale process, we're at 3. You've got at least another year afterwards. So you're at 4 years before you leave, and it might be 2 years. So you're at 5. So if you're thinking a 5-year timeline, now is the time to really start thinking about building your company for a sale, to start doing the preparation. And a lot of people just don't realize it takes that amount of time to go through this process. The stats that are out there in terms of successful sales, I think it's something like 75% of businesses that go to market don't actually sell. It's a pretty high stat. It's a fairly scary stat. I don't know if like the above million EBITDA is quite to that extent, but I have seen clients go through a process, and this is when I was on the M&A side and actually selling companies, and not go through it for some of these reasons, whether it's client concentration or a lot of family members as a part of the business, and then all of a sudden you're going to do 2 years to rebuild, and you have to go through that process again. So you want to make sure that when you go through it, you are ready, you understand the process, you understand what it means to you, and you can go forward, because it can be 5 years before you are truly out of your business.
Well, there's a lot of stats that I've read, or like, that are going around, that you just mentioned one of them in terms of the number of percentage of company that don't actually end up selling. Another one is 76% of Canadian business owners plan to exit in the next decade, 2 trillion in business asset changing hands. What's your view on this statistics in Canada particularly? Has it started already? Where do you think we are in this cycle? Do you think it's overstated in terms of statistics? And given the age of the founders and the owners that maybe tend to be, maybe a baby boomer generation and whatnot. What's your take on that?
I think there are some generational gaps between how folks are thinking through it. I think that a lot of, let's say, 65 plus business owners today are not as focused on the exit. I think the stats are there. There are business owners that are aging. They will need to exit their company at one point, whether they want to or not. None of us will live forever at the end of the day. But a lot of them don't want to go through that planning and think through it. Most of our clients tend to be sub 60 in age, and they're thinking of, I don't want to do this forever. I want to be out at a certain timeline. Or if, they have the dream outcome today, then they can do that and think about building something else in the future. So I think there's a generational divide as to, how a millennial versus a boomer is going to approach the problem. I do think it is something that does need kind of like national attention towards it. I do think that we need to enable business successions to happen. There are some things happening. I believe in New Brunswick, they have some programs, especially for smaller businesses, to get valuations, start understanding this. There's some Ontario Succession, I think, is one that's starting to grow in Ontario and starting to provide more things. And I think they're earlier days, although I might be wrong on that. I haven't had a conversation in the last year or so about that. It is a problem that needs to be solved. It's going to happen. Businesses owners are going through it. I do think that there are lots of buyers. You might hear the term search funders, people who either have some operating experience, maybe they recently graduated their MBA, maybe they were, a C-suite executive at a large company. They're looking to buy businesses and operate them and grow them themselves. We talked about how owning your own business can be like a real value creation lever for you personally. And scaling a company, you can make a lot more money doing that than you can through most traditional investment paths. And people who want to put in the work and take that risk and try to build something, it's a great opportunity. And so I think there's a lot of buyers in that search funder pool who are looking to buy, especially some of the smaller businesses in Canada, what you might call some of your main street shops. And, I have seen it with some friends. I know people who have bought like septic tank companies, like to go and pump septics, and doing roll up strategies, like trying to buy multiple of those businesses. Because if you buy, 5 of them and they all generate $500,000 a year or something, you're at $2.5 million in EBITDA, your multiple at that point is much higher than the individual one. And so there's value creation just as a result of having a larger asset to sell. So long story short, it is very real. There are lots of business owners who are going to have to go through this process. I do think those that take the time to think ahead and plan for it and want to invest and understand, what does this mean for me? How do I go through this process and optimize it for themselves and educate themselves, will come out better at the end of the day. I think that if you wait too long, you will lose value. On the M&A side, I was part of a process where the owner was in their 80s and they held off. And unfortunately, they passed away before we actually went to market with the company. And so we ended up dealing with the executors in the estate. It's a very different process, and that owner had a lot of dependencies on them. And so they lost a substantial amount of value in their business. And I don't think anybody wants that to happen to them. And, their kids having to deal with that on the estate side of things. And so I would encourage owners to think through that process and to educate, because if you understand, how your company should be valued, regardless of what industry or what size you are, that's really important, because somebody can come in and they might offer you something. And it could feel like a great deal, but it could also be not what you should get for your business. And we really want business owners to maximize their own value for their company, regardless of what that is at the end of the day.
One of the biggest challenge or things that I come across, which is a very fine line, is I'm trying to help business owners. Of course, encourage them, go all out, all in your business. Don't get me wrong. But one of the things that I try to bring is perspective. I try to kind of de-risk their overall risk, and I'm trying to diversify their wealth so that perhaps like if their business growth doesn't really pan out as maybe it was intended to, then at least they're set, so to speak, on other areas of their life, right? Their retirement is funded, their kids' education, all that kind of stuff. From your perspective, how do you help founders navigate this de-risking process? Because it's tricky. You mentioned, they want to grow at 30% a year over year, and then maybe you should have comfortable. What would I invest in? 10 to 20, 8 to 10, in and out, right? Which is an interesting conversation. So hence why you see very large Horner concentration, tied to the business. And then when it gets carried to the estate, I mean, that's very unfortunate. There's a ton of value lost there, and total wealth being missed in terms of not being transferred, right, to the next generation in that specific case. So how do you help founders, I guess, de-risk themselves, throughout that process?
Yeah, I think the number is somewhere around 90% of most business owners' wealth
Yeah.
is in their
It's
business, which obviously is substantial. And if we were to talk about this from a client concentration risk for your company, if you had 90% of your revenues in one client, it's gonna be like, oh man, that's pretty big. That's scary. You're gonna lose a lot of value for that. And so it's always interesting when you flip the conversation. You say, okay, well, your own wealth is tied up in your company. Isn't that
yeah.
fairly risky? And the short answer is like, yes. We talked about having an exit and selling your business and a dream outcome. But the reality is, politics can change, industries can change, tariffs can change, and that can have a massive impact to the value of your company. And often it can be something out of your control in a short time frame. So I really appreciate you bringing up the fact of like protecting the downside risk. And I think I mentioned a little earlier on of like you want to protect the value you've built before you start going and trying to do like real value creation components in your company. And so that's why for us, we do want our clients to work with their financial advisor and have that conversation around, do I have my estate planning and my wills done? Do I have the life insurance that's going to protect my family if something were to happen on that component? You do need to protect those things. They unfortunately do happen. I have seen those stories. So it's not something fun to go through or to see somebody go through. And so you want to make sure you have that protection. It's absolutely essential. Even though there might be a small upfront cost, the payback on that should something happen is infinitely higher than the cost from the business owner and like their investment portfolio and that sort of thing. I think that for a lot of clients, they often feel they can get much higher returns in their business. But I do think that there is very much a conversation around diversification and having some of that liquidity, making sure you are paying yourself personally. Something that we come across on a semi-regular basis is owners who are underpaying themselves. And if you're not going to be doing that to try and be scaling your business, when a buyer comes to buy your company, they're going to say like, well, market rate for you is, let's just say you're 100,000, it's $200,000. Like we're going to adjust your earnings to be a business where you're paying $200,000. We're going to take 100 grand off of your earnings, and so you kind of get penalized for that on a value perspective. Make sure you're paying yourself something efficient. Make sure you are taking some of those things off to the side. You don't want to have liquidity crises as a business owner. We have something scaling. My framing is often just like what lets you sleep at night. At the end of the day, I do think some owners are going to have much higher risk tolerances. I have had clients where they don't want to engage with a financial advisor, but I think there's a ton of value in that conversation. I think having somebody who's outside of your purview, um, and is thinking about this from like a portfolio diversification perspective of like, hey, we do need to make sure that we have something there. We do need to make sure we're protecting what you've built, and taking some chips off the table over time is a really good strategy to follow through. So I hope that answers your question.
Yeah.
But it can very much change, and I'm curious how you see it with business owners, like in those
Yeah.
conversations.
Yeah, for sure. I mean, with a plan, I try to always undershoot or assume an exit value that like is potentially, especially if they never had like a formal evaluation of their business or they're still in the growth stage and they still and have anywhere from 5 to 15 years to go. I try to just undershoot an exit value and then include some tax planning opportunities there, maximizing the lifetime capital gains subject to approval and the fact that they meet all the requirements. But that's kind of usually where we build a plan around. And then throughout, I try as much as possible through their compensation to try to build them like a diversification optionality throughout. So by the time that they're ready to retire or sell their business, they're not totally dependent on that exit value. But like you mentioned earlier already, that exit value is going to substantially influence how much you can be able to spend, in retirement and their overall wealth. Like there's no doubt about it. It's a massive component. It is a very important component.
Yeah,
I think
and I think
go ahead.
from the perspective of maximizing your efficiency, as you will, like getting money out of your business, that can turn into like a multi-year plan as to how you're going to pull out, like, hopefully you have millions of dollars in retained earnings in your company. how do you start pulling that out of the business? And how do you do it in the most tax efficient way? And having those conversations with somebody who can help you do that planning and think through, okay, how do we minimize your taxes? Because you can very well be talking, 6 and 7 figure numbers fairly quickly of reducing your tax burden if you're thinking ahead and really trying to optimize that, and then putting it into investments on the other side that obviously makes sense for the client.
Yeah, that's awesome. That's a great way to kind of wrap up the episode, Matt. I really appreciate you coming on the podcast. I will put your link below. So your website, which is withhorizon.co, your email as well, and your LinkedIn. So if people wants to, especially if you're a business owner and you have any questions about Matt's work and how they work with business owners, you'll have all the link below to reach out. But with that being said, thank you for listening. And Matt, thank you again for being such a wonderful guest and have a great conversation about challenges about business owners, what they can do to remove themselves as bottlenecks and they overcome some challenges and then ultimately maximize, their hard works over decades and decades, right?
Absolutely. And if anybody wants to email me, it's matt@withhorizon.co. And I'm happy to have a conversation. Part of our onboarding process is having a complimentary session with business owners who are within our ICP, our ideal client profile, kind of that $1 million EBITDA range. And we provide an estimated value for them. And we go through and do an advisory session and give them a 90-day roadmap with 1 to 3 things to increase enterprise value. So if it's of interest, definitely reach out. But Guy, thank you so much.
Yeah, perfect. Hey, with that being said, enjoy the rest of your week and we'll see you in the next episode.